Welcome to the deep dive. We're diving straight into the Bulls, Bears, and the Bell Morning Edition briefing for October 10th, 2025. And what really jumps out today is this strange quiet, a facade of tranquility, you might say. You look at the screens, futures are basically flat, indices aren't really going anywhere, but underneath, you can feel this significant kind of coiled tension. So our mission for you today is simple. We need to cut through that quiet, identify the one single event that really has the power to swing the market for the rest of the week, and then build a playbook around it. The idea is that when that data hits, you're not just reacting, you're executing a plan.
Yeah, that tranquility. It's the ultimate market head fake, isn't it? We are genuinely sitting at a really critical inflection point. Think about it. On one hand, you've got these stark macroeconomic warnings. Recession flags are popping up. Our data shows something like 22 state economies are either in recession or getting dangerously close. But then on the other hand, you see these intense, almost irrational pockets of speculation, stuff that keeps the big indices looking okay, even while the foundation feels shaky. Look, that tension just can't hold indefinitely. The market knows it, which is why everyone, and I mean every trading desk, every fund manager, every retail trader has their eyes locked on one specific time, 10:00 a.m. Eastern. That's when the University of Michigan Consumer Sentiment Report drops. And honestly, that single report is the arbiter for today. It could confirm those recession fears, or it could ignite a massive, potentially short-lived rally.
Okay, let's start there then. Before 10 a.m. hits, what's the pre-market posture look like? This low conviction vibe, how's it showing up on the dashboard?
Well, it looks like pure hesitation, just pure waiting. You check the S&P 500 futures, the Dow futures, they're indicating what, maybe 0.1% gains.
Yeah.
Tiny fractional moves. It's not conviction. It's not a bet on direction. It's just holding pattern. People are positioned defensively, keeping capital on the sidelines rather than committing before this big event risk hits.
And this isn't just a Wall Street thing, right? It's global.
Oh, absolutely. This indecision is mirrored everywhere. Look at Europe overnight, the Stoxx Europe 600, trading completely flat. It tells you there's just this global absence of anyone wanting to make a big directional bet right now. It really underscores that the U.S. consumer, and specifically their inflation outlook, is probably the single most important macro variable on the entire planet at this moment.
Which leads us straight to strategy. Given that backdrop, it feels like today demands a really cautious, tactical approach. Less about chasing big wins, maybe, more about protecting capital.
That's the absolute core insight for today. The risk profile is incredibly asymmetric. That's the term, asymmetric. For anyone managing serious money or even just, looking at their 401k, this is the thing to really internalize. A negative surprise, a really bad U of Michigan number could trigger a much, much bigger and faster drop than any potential gain from a positive surprise.
Okay, why is the downside risk so much more severe? What's driving that asymmetry?
It's because the market structure is already kind of leaning that way. We've seen weakness under the surface for weeks, right? Even if the big tech names hold things up sometimes, investors are just incredibly sensitive right now to anything that confirms the Fed might be trapped, forced to choose between fighting inflation and maybe tipping us into a hard landing. So if the consumer suddenly throws up their hands and says, yeah, we're really pessimistic now, boom, you could see a very quick, very violent repricing across the board.
And even if the news is good.
Even if the report's great, the upside might be capped. Because think about it, really strong consumer health? Well, that just gives the Fed more reason to stay tighter for longer, doesn't it? Maybe even hike again down the road. So you're basically trading a potentially small reward for a potentially huge risk. It's not a great bet from a risk management standpoint.
Right, so capital preservation is key. Rigorous risk management. Be surgical.
Exactly. And if you happen to be trading actively today, you absolutely have to circle 10:00 a.m. Eastern on your chart. That's when we expect peak volatility.
Yeah.
And it won't be a slow drift, it'll be instant. Algorithms, high-frequency traders, everyone reacts simultaneously, covering positions, placing huge bets in milliseconds. It's going to be sharp.
Okay. Before we dive deeper into that 10 a.m. report, let's just acknowledge this background shift happening. The market's kind of pivoting, isn't it? Moving slightly away from just pure macro dread towards, earnings season.
Yeah, that's a really important piece of context. Today's earnings calendar is actually pretty quiet. And because there's no major company news grabbing headlines, it just amplifies the focus on this one macro data point, the consumer. But this quiet, it's definitely the calm before the storm. Next week, Q3 earnings season kicks off in earnest. We get the big banks, JP Morgan, Bank of America, they're the bellwethers. We'll talk more later about why their reports, especially what they say about loan losses, are so critical. But for today, the spotlight is firmly solely on the U.S. consumer.
All right, the main event then, 10:00 a.m. Eastern, the University of Michigan preliminary survey for October. This isn't just a mood ring, is it? It's tapping into the health of, 70% of the U.S. economy and, crucially, future inflation. So let's get specific. What are the exact numbers we need to be watching for?
Okay, three main things to track. First, the big one, the headline consumer sentiment number itself. The consensus forecast is looking for 54.2. That's actually a small dip from 55.1 last month. Now, if that number comes in way below consensus, say it drops into the low 52s or even 51s, that's a major red flag. It signals consumers are really getting worried about their jobs, their finances right now. That's the kind of fear that triggers a real pullback in spending.
And what about how they feel about the future, the expectations component?
Right, that's the consumer expectations piece. Forecasts are for it to be pretty stable, around 51.7. If it holds steady, it suggests, okay, maybe things feel tough now, but people haven't totally given up hope for 6 months down the line. But honestly, the most critical part of this entire report, the bit the Federal Reserve will dissect more than anything else, is the inflation expectations. That's the real driver for policy.
Ah, yes, the inflation beast. Still sticky. What are we watching there specifically? 1 year, 5 year?
Both. You've got to watch the trend in both the 1-year and the 5-year inflation forecasts. Last month, the 1-year was 4.7%. The really crucial one, the 5-year, was at 3.7%. Now, if that 5-year number starts to tick up again, even just a little, say to 3.8% or 3.9%, that is a terrible signal for the Fed.
Why is that long-term number so much more important?
Because it suggests inflation expectations are becoming unanchored. It means people are starting to believe higher prices are permanent, and they're building that into their long-term planning, their wage demands, everything. That psychological shift makes inflation much harder to fight. It becomes self-fulfilling. And that forces the Fed to keep policy tight, maybe even get more aggressive, regardless of what the growth picture looks like.
Okay, let's game this out. Scenario planning. Walk us through the worst-case outcome, the one folks like Jamie Dimon seem worried about. What does that look like?
Right, scenario one, the bearish stagflationary signal. This is the nightmare. The trigger is twofold. Sentiment falls off a cliff, maybe below 53, and those long-term inflation expectations creep higher. See the problem? The economy is clearly slowing down. That validates the recession fears. But inflation isn't budging, or it's getting worse. That ties the Fed's hands. They can't easily cut rates to help the economy if inflation's still the main problem.
And the market reaction, swift and brutal.
Oh yeah, immediate sharp decline in equity futures, the most economically sensitive stuff, small caps, cyclicals. Think the Russell 2000 would get absolutely hammered. You'd see a flight to safety, so the US dollar index, the DXY, would likely rally hard. And here's the tricky part. U.S. Treasury yields would probably rise.
Wait, yields rise. If we're heading towards recession, wouldn't people pile into safe treasuries, pushing yields down?
That's the classic recession playbook, yes. But this isn't just recession. It's stagflation, stagnant growth, plus inflation. In that specific scenario, the market prices in a Fed that has to stay hawkish to fight inflation, even if it hurts growth. So rising inflation expectations mean investors demand a higher yield to compensate for inflation risk on long-term bonds. Yields go up because the market thinks the Fed can't cut rates, not because the economy is booming. It's a painful combination for stocks.
Got it. That's a crucial distinction. Yields rising due to Fed constraints, not growth optimism. Okay, now flip it. What's the dream scenario? The soft landing narrative gets a boost.
That's scenario two, the bullish soft landing signal. This is what the bulls are praying for. The trigger here is sentiment coming in better than expected, say above 56, and crucially, those inflation expectations showing a noticeable decline. This tells the market, okay, the consumer is holding up, the economy is resilient, and the Fed's tightening seems to be working on inflation without crashing everything. Best of both worlds, kind of.
And the market reaction. Risk-on party.
Pretty much. You'd likely see a big risk-on rally. Equities surge, especially the sectors that love lower rates. Think growth, tech, the NASDAQ 100. The hope for future rate cuts comes back into play. The U.S. dollar would probably weaken quite a bit as money flows out of safe havens. And treasury yields, they'd likely fall, reflecting those lower inflation expectations.
Okay, and the third possibility. The messy one.
Scenario three, the muddled interpretation. This happens if the data comes right in line with expectations, basically telling us nothing new. Or worse, if we get conflicting signals like maybe sentiment looks okay, but that 5-year inflation number jumps unexpectedly. If that happens, there's no clear story for the Fed. Is growth the bigger worry, or is inflation still the main enemy? Investors just won't know. The result, probably heightened volatility, big swings back and forth, Choppy, directionless trading as the market struggles to figure it out. Maximum confusion, basically. Trader's headache.
Right. So while U.S. consumer is clearly in the driver's seat today, the global picture still matters for setting the overall mood, doesn't it? Let's touch on some of the other data we got earlier. Canada's job numbers at 8:30.
Yeah, the Canadian jobs report is actually a pretty important piece of the puzzle. It gives us a read on the North American consumer more broadly, not just the U.S. The forecast was for unemployment to tick up slightly from 7.1% to 7.2%, but the real concern was job creation. Remember, they lost a shocking 65,500 jobs last month? The market was only expecting a tiny gain back, like 5,000 jobs this time.
That's basically treading water after a huge hit. What does that signal for the Bank of Canada?
It puts immense pressure on them to lean dovish. Very dovish. Unlike the Fed, who's still primarily fighting inflation, the Bank of Canada is looking at clear signs of economic slowing. If those job numbers disappoint again, it just cements the idea that the BOC might be one of the first major central banks to actually start cutting rates. And for currency traders, that directly impacts USD CAD. A weak Canadian outlook generally means a stronger US dollar relative to the loonie.
And we saw similar signs of economic fragility coming out of Europe overnight too, right? Italy's industrial numbers.
We did. The Eurozone data just keeps reinforcing this narrative of a very, very fragile recovery. That Italian industrial production number for August was frankly shocking. It fell 2.4% month over month. The forecast was for a drop of only 0.4%. So it was more than 5 times worse than expected, a huge miss.
Wow. A drop like that in a core Eurozone country like Italy, what does that signal more broadly?
It signals deep problems that are likely spreading. Italy's industrial sector struggling often foreshadows or mirrors issues in Germany and France. It just adds to the gloomy outlook for the whole Eurozone. And importantly, it puts the European Central Bank in a really tough spot. They're trying to fight inflation too, but they're also terrified of causing a recession or fragmentation, especially in weaker economies. Bad data like this forces the ECB to be more cautious, maybe less aggressive on tightening, which tends to keep the euro weak against the dollar.
Okay, so after the Amish data hits at 10 a.m., attention immediately shifts to the Fed speakers later today. We've got Goolsbee and Musalem scheduled.
Yeah, the timing is almost perfect, isn't it? The market will be hanging on every single word from Austin Goolsbee around 1:45 p.m. Eastern, and then Alberto Musalem later at 5:00 p.m. And they won't just be giving standard speeches. Reporters, analysts, traders will be parsing their comments for any reaction, even subtle hints about the consumer data that just came out hours before. We'll be listening for clues on that central question. How is the Fed really weighing this trade-off? Slowing growth versus sticky inflation expectations. Their tone could either pour oil on troubled waters or just add more fuel to the fire.
Okay, let's zoom back out to the broader market dashboard. Futures showing hesitation, we know that. What about other cross-asset signals? Fear gauge, commodities, positioning.
Yeah, it all kind of confirms this tentative mood. We talked about index futures being flat. Now look at volatility. The VEX is trading down near 16.34. Now, on the surface, 16.34 looks calm, but you have to add the context. October has this historical reputation for being volatile, right? The whole October crash narrative exists for a reason. Seasonal patterns often show volatility picking up this month.
So a low VIX reading now isn't necessarily a sign of safety. It might be the calm before the storm.
That's exactly how we're reading it. It feels like the quietest moment, waiting for that 10 a.m. catalyst. Will it bring relief or will it trigger a big spike in fear? We just don't know yet. Similarly, the U.S. dollar index, the DXY, is flat around 96.48, just locked in place, waiting for a signal on whether U.S. rates are likely to stay higher for longer compared to the rest of the world.
And commodities seem to be reflecting those growth worries we talked about.
They really are. Crude oil, both WTI and Brent, is down around 0.6%. That weakness is almost entirely being chalked up to worries about global growth. If China's slowing, Europe's fragile, the U.S. consumer is shaky, demand for energy is going to take a hit. Meanwhile, gold is stuck in the middle, around $7,710. It's got the pull of being a safe haven amid all the uncertainty and recession fears. But it's also got the pushback from a potentially strong U.S. dollar if inflation stays hot and keeps the Fed hawkish. Classic tug of war.
Okay, let's unpack this. Here's where it gets really interesting, right? The contrarian signal from retail traders, what's the positioning look like there?
This is potentially the hidden accelerant for today's market. It's why even a mildly positive surprise could cause an outsized move. Our data sources, looking at firms like IG, show retail traders are incredibly bearish right now. Get this, 52% are short the Dow Jones, 53% are short the NASDAQ, and a whopping 55% are short the S&P 500.
Wow. So more than half of these typically shorter-term traders are betting heavily on a market drop. Why is that specific mass pessimism such a key signal?
Well, historically, when you see retail sentiment get this extremely bearish, we call crowded positioning on one side of the boat, it often acts as a contrarian indicator. It suggests pessimism might have gone too far, and the market could be near a short-term bottom or at least very oversold. But crucially, this heavy pile of short bets creates a massive tactical, short-term bullish risk.
Explain that. How does everyone being bearish create bullish risk?
Think of it like a coiled spring. You have all these traders betting the market will fall. Now, what happens if the U of Michigan data comes out just better than feared? Not necessarily great, just not terrible. Suddenly, all those short sellers are looking at losses. They're forced to buy back the shares they shorted just to cut their losses and get out of the trade. This isn't buying based on fundamentals, it's forced buying. And that forced buying pushes prices higher, which forces more short sellers to cover, which pushes prices higher still. It's a positive feedback loop. We call it a short squeeze.
So if we get that scenario too, the soft landing signal, the rally could be way more violent and faster than the actual economic news warrants just because of all these shorts getting squeezed out.
Absolutely. The short squeeze acts like a huge amplifier on good news. It means the market's upside reaction could be disproportionately sharp and sudden. It's a critical tactical overlay for anyone navigating this 10 a.m. data print.
It's fascinating how that macro paralysis in the indices contrasts so sharply with some of the wild moves we're seeing in individual stocks pre-market. A real macro versus micro battle playing out.
Yeah, it's proof that capital never sleeps, right? It'll always find somewhere to go, even if the broad market is on edge. Let's look at some top gainers. Safe and Green Holdings, ticker SGBX, up an incredible 143.52% pre-market.
143%. That can't just be hype. What's the catalyst?
It was a major company-specific de-risking event. SGBX managed to regain full compliance with all of NASDAQ's listing requirements. The threat of being delisted gone. That's a huge weight off any stock. How'd they do it? Well, partly a reverse stock split, but the big piece was restructuring a deal with a company called Boral. This move dramatically reduced potential future share dilution by over 80%, removing that much potential overhang. That fundamentally changes the risk-reward calculation.
And we're also seeing that familiar speculative buzz around recent IPOs, especially the ones with small floats.
Exactly. When the macro picture is muddy, liquidity often chases these high-risk, low-float names. Look at 1&1 Green Technologies, YDDL. It's a recycling tech firm, just went public, soared over 100% after hours. Why? Purely technicals. The public float, the number of shares available to trade is tiny, maybe 2 million shares. With a float that small, it doesn't take much buying pressure to send the price rocketing. It shows traders are willing to gamble on novelty when the broader market's stuck. Same thing with Life Risk Co., LFS, which debuted yesterday and is still seeing momentum.
Okay, now let's look at the losers column because there's a concerning signal there too. Dell Technologies, DEL, down about 5% pre-market, continuing a slide. Why does a slump in Dell matter?
Yeah, the Dell weakness is something you really shouldn't ignore, even with all the excitement in microcaps. Dell is a major bellwether for enterprise spending, what big companies are spending on hardware, PCs, servers. Its continued slide suggests growing unease about corporate budgets. Companies are tightening their belts, delaying upgrades. It points to a slowdown in that core IT spending.
And this highlights a split within tech itself, doesn't it?
Absolutely crucial point. You still see massive excitement and investment flowing into very specific future-oriented tech areas like AI chips. NVIDIA is still flying high, right? But the companies relying on more traditional enterprise hardware cycles, like Dell, they're starting to really feel the pinch. That divergence tells you capital spending is becoming very selective, very cautious about the broad economic outlook. It's not flowing everywhere anymore.
Right. We also saw some other noise like CDT equity down after a reverse split, some penny stock volatility in Nibiru. But Dell feels like the significant macro read-through there, signaling weaker corporate spending.
Definitely. And that ties directly into how we should interpret today's consumer data. We had some really interesting kind of conflicting signals just yesterday from Q3 earnings that help frame the consumer mindset right now.
Yeah, let's look at those. On one side, you had PepsiCo, PP, reported Q3. They talked about sluggish U.S. demand, but the stock actually went up over 4%.
Right. The stock gained because while demand was sluggish, the results weren't as bad as the market feared. Expectations were really low. But the underlying message is key. Consumers are pulling back on everyday items, on consumer staples, groceries, snacks. They're feeling the pinch, watching their budgets on those tangible goods.
But then contrast that with Delta Airlines, DAL. also reported yesterday, also rallied over 4%. And their message was pretty upbeat, right? Confirming strong demand, especially corporate travel still holding up.
Exactly. And this is the core bifurcation we're seeing in this late-stage economic cycle. Delta's strength shows people are still willing, eager, even to spend big money on services and experiences, travel, vacations, going out. And corporations are still funding business travel. So put it together. What's the consumer doing? They're rationing. They seem to be cutting back on buying stuff, like you see with Pepsi impacting XLP, XRT-type sectors, but they're still prioritizing doing stuff, like flying Delta, boosting GDEETs, PEJ-type sectors. The big question for today's U of Michigan report is that sustainable? If sentiment really craters, does it mean the pressure is now so bad they're about to cancel the trips and restaurant meals too? Or if sentiment holds up, does this split economy, weak goods, strong services continue a bit longer?
Looking ahead then, we talked about Q3 earnings kicking off next week with the big bangs at JP Morgan, Wells Fargo, Bank of America. Why are their reports specifically such a critical focus for judging the economy's real health?
Because the banks are the ultimate canaries in the coal mine. They see everything first. We know exactly how healthy consumer and business balance sheets are because they're the ones lending the money. So when they report next week, yeah, people will look at net interest margins, loan growth, but the metric everyone will be absolutely fixated on is provisions for credit losses.
Explain that for our listeners. What are provisions for credit losses and why do they matter so much?
Okay, think of it this way. Provisions are the money banks set aside today to cover loans they expect to go bad in the future. It's the bank basically saying, uh-oh, based on our models and what we're seeing, we think more people are going to default on their credit cards or their mortgages or their business loans down the road, so we need to build up a cushion now. Oh, it's an explicit, forward-looking prediction of trouble. A bank doesn't just increase these provisions for fun. They do it because their internal data is flashing warning signs. So if we see a big, unexpected jump in these provisions next week from the major banks, the market will read that as a massive red flag. It could signal serious stress building in consumer debt, maybe commercial real estate, widespread economic pain potentially starting to surface. Honestly, a big spike in provisions could totally overshadow even a decent consumer sentiment number today. It could trigger a really broad systemic sell-off, signaling that the foundations of the credit market might be cracking.
Okay, let's pull all these threads together. We're sitting in this really fragile equilibrium today, aren't we? You've got the deteriorating big picture, Europe slowing, consumers cutting back on goods, clashing right up against this pockets of intense speculation and, crucially, that heavy bearish positioning from retail. And the U.S. Consumer Sentiment Report at 10 a.m. is the event that could break the deadlock.
Exactly. And the market's technical setup confirms just how fragile things are. You need to watch key levels today. On the downside for S&P 500 futures, that overnight low around 6802.00 is critical support. Given how nervous things are, if we break below that after the data, selling could really accelerate fast as the technical bears pile on.
And what's the level on the VIX that would tell us fear is genuinely taking over the broader market?
Keep an eye on the VIX moving above 17.5. If it breaks above and stays above 17.5, that's usually a sign that fear is really spreading, that we're breaking out of this calm facade and a broader downturn is likely taking hold.
So thinking about our three scenarios for the data, how should you mentally align your strategy beforehand? All right, if we get the risk-off scenario, weak sentiment, maybe higher inflation, that stagflation signal you're thinking needs to be defensive, you'd favor sectors that tend to hold up better when growth slows down, so maybe long consumer staples, utilities, and you'd look to short or hedge the high beta stuff that needs growth technology, consumer discretionary. Conversely, if we get the risk-on scenario better sentiment, lower inflation, expect that short squeeze. That likely favors technology, growth sectors, areas that benefit from falling yields. But, and this is key, remember that rally might be sharp but potentially short-lived because really strong data just puts Fed hikes back on the table eventually. And finally, look, we can get caught up in the minute-by-minute tactical battle today, but we absolutely cannot ignore the bigger picture warnings. You mentioned Jamie Dimon earlier. His comment about the probability of a serious market fall being more like 30%, that's not just noise.
Why does that high-level CEO pessimism carry so much weight when today's data is just about the consumer's mood right now?
Because it signals a deep concern at the very top levels of finance that asset prices, stocks, bonds, everything might simply not be reflecting the true underlying risks. Risks that go way beyond this month's consumer sentiment reading. Think about massive geopolitical instability, The long-term consequences of huge government spending, global conflicts forcing remilitarization, these are huge, systemic risks that aren't easily captured in a monthly survey. Diamond's warning provides crucial bearish context. It suggests that maybe the market is priced for a relatively smooth path, while some very serious people see significant potential for things to go wrong. Today's data point is just one test. Will it support the current optimistic pricing, or will it be the first concrete sign validating those deeper fears?
So we've laid out the variables. Today is absolutely defined by event risk. It all hinges on the U.S. consumer's mood and, crucially, their inflation expectations at 10 a.m. And remember, that heavy retail short positioning could act like gasoline on the fire, making any reaction potentially much more violent.
Exactly. We've given you the map, the scenarios to watch for, the key levels. Now, you need to decide as you watch that data hit, is this the print that provides enough support for the bulls to keep running, at least for a while? Or is this the first domino finally starting to fall, confirming the adverse scenario that people like Diamond are clearly worried about? And here's the final thought to chew on as you wait for 10 a.m. The market right now is priced in a certain level of risk based on what we know, based on the economic data we track. But given those stark warnings from financial leaders, how much hidden risk from geopolitics, from fiscal policy blowback, things not easily modeled is truly not reflected in current prices? And maybe more importantly, how will next week's Q3 bank earnings, especially those credit loss provisions, start to reveal that potential disconnect between market pricing and underlying systemic stress? That disconnect, that's the bigger question looming over everything, regardless of how today plays out.